Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what we can talk about? Well, based on a couple of things which I'll share with you in just a second, I'm going to take a break from some of the things we have been talking about recently and talk about technical analysis apologetics. Now, you might say, what the hell is that? It's like, well, that's a term I just kind of pulled out of the air. Years ago, I totaled a perfectly good car, and I've always been kind of a little agnostic, little Christian, probably mostly Christian, but somewhat agnostic here and there. And the fact that we made it out of this car crash relatively unscathed. My wife did have a minor surgery on her hand, which she reminds me of often. But other than that, we really were pretty lucky. And she kind of used that as a nudge to get me into church, at least for a while. And during that brief stint, I did actually take a Bible class, which people who know me personally find kind of shocking. And then at one point I was actually assisting and teaching the class. And I think one thing that helped me, and it was a bit of a godsend, no pun intended, was the guy who taught the class was an expert in apologetics. And he also taught classes in apologetics, so he sort of had an answer for any of my questions that I might have had. And apologetics is reasoned arguments for something. Usually it's religious based. Usually you hear the word with religion. But I'm going to make a case for technical analysis, and that you can beat the market with technical analysis, or at least not let the market beat you. Now, what I mean there is when I'm talking about market timing, I'm referring to the fact that market timing is less about beating the market and more about not letting the market beat you, because every now and then the market loses about half of its value, and if you're buy and hold, so will you. Housekeeping, I do take requests. You can send any request to DaveLandry.com/contact. Makes my job a lot easier knowing what I'm going to cover ahead of time. If I can't fit it into this show, I do my own show every week on Thursdays. Right now it's at 6 Central Time, and I would love to have you there. You can go to DaveLandry.com/webinar to register. Register once and you register for all, and even if the link is old, go ahead and register. If you need to send me something that you would like me to cover, or you have any questions, DaveLandry.com/contact. And if you want the slides from this presentation and all the other presentations, DaveLandry.com/StockCharts. There's my Twitter handle, which someday I need to fix and make a little bit better. I have a bit of a sickness where I buy books even though I'll probably never get around to reading them, and eventually I do, but it might take a long time. Anyway, I'm not sure where this book came from, but it was in my bookshelf, and I grabbed it the other day and began reading it. And I have a bit of a problem with a lot of these behavioral finance books and behavioral science books, and now I'm noticing the neuroeconomics and the neuroscience books, which are beginning to become more and more popular, have a bit of the same problem, and this book was no exception. And one of my beefs is they all seem to draw heavily upon Kahneman and Tversky, and specifically Thinking Fast and Slow, which is a bit of their lifetime worth of work. And I would suggest you read it. It's about 600 pages, but there's a lot of good stuff in there, and it does relate to trading, and a lot of these books draw heavily upon. And I just kind of skim over that stuff because I've read it before. But I think my biggest problem is they tend to make assumptions about market truths to make their point. And for instance, this book here, and I'm only about 60 or 70 pages in, but they were talking about how bad it is that people go after speculative stocks. Well, if it wasn't for speculative stocks, I wouldn't have any business trading, because that's 99% of what I do in speculative markets such as Bitcoin, at least back when it was running, another crypto. Anyway, they really make all these assumptions, and I was looking for some specifics that I could point out to you and kind of picking it apart a little bit. And then I turned the page and I found this. Millions of investors believe in technical analysis, which supposedly predicts future prices on the basis of past prices, and in market timing, which purports to enable you to get out of stocks before they go down and back in before they go up. There is little, if any, objective evidence that either tactic works in the long run. Well, I'm going to strongly disagree with this. Now, the thing about fundamental analysis, and then this gentleman, I think his name is Weg, was talking about the fact that technical analysis doesn't work and that speculative stocks are a bad thing. But I disagree, and he also kind of hinted that you should be buying good stocks, and there are no good stocks unless, of course, they're going up. And there's nothing with fundamental analysis that you could say, okay, if this stock has this or that or whatever, fundamentally wise, it should go up. But with technical analysis, there is concrete rules. And the most basic of all is if a market is at $10, let's say point A, and it's going to point C, which let's say is $30, it's going to have to pass through B, assuming B is $20, somewhere along the way. Now, as I often preach, you can't just always buy at B, although I do have an IPO pattern that has quite a few caveats, but you actually do just that. You're buying a new closing high. Now, conversely, on the downside, if you're going from A to C, and C is $10 and A is $30, you're going to have to pass through B along the way. That's a fact, okay? And there's no denying it. And by the way, the only way to ever make money trading is to capture a trend. So I'll come back to that in a few minutes. Now, my version of technical analysis is performance-based investing. If you were going to build a team of employees, you'd want some hardworking people. And if one out of the, let's say you hire 5, if 1 out of 5 really isn't pulling his or her weight, you probably would get rid of them. But in a lot of cases, people do just the opposite with stocks and other investments. They hang on to the one that's not working and they get rid of something that's working. So whatever I get into some sort of trade, and I hope to be in that trade a long, long time, and the money management usually takes me out a lot sooner than a long time, but I've been in one for about 1.5 years now, which I'll show you in a few minutes. And I've ridden a few great trends in the past for a long, long time, but I have a performance metric in my mind, and if the market, whatever the market may be, loses X amount, then I am out. Now, that X amount for the S&P 500 is 10%, I think, is a really good number, and that's what a lot of my testing is based on. Now, keep in mind, if you're trading a crazy biotech or an IPO, it might be 20%, 30%, or even more. And, of course, we adjust the share size down to compensate for that. Now, along the lines of showing that technical analysis can work, what if we bought markets after significant Landry Light, and I'll show you that in 1 second, and after they correct to the moving average on a resumption of trend? In other words, I'm talking about Landry Light Pullbacks. So you can see the Landry Light down below, and that just simply means the lows are greater than the moving average. And this right here shows a market that's trending that continued to trend. Now, there's no guarantees, obviously, it will continue to trend, but if you see a trend in the market, lots of Landry Light, so to speak, lows greater than the moving average. In this case, I'm using the 30 EMA, but you could use your favorite moving average. My favorite is the 30 EMA. I know you probably want to party with me. But anyway, you can see that trend continued. There's no guarantee of that, obviously. And if you wait for that market to pull back to the EMA, you can see this down here counts the number of bars that we are above the EMA, number of lows that is above the EMA, and that's green. When it's below, you can see down here, it's red. So as a general statement, as I said a couple of years back when I first started doing these Trading Simplified shows, green, good, Tarzan speak, and red, bad, Tarzan speak. But a very simple pattern is just wait until you get a nice little trend, look for a correction back to the moving average, and then look to get long as that trend resumes. So that would have gotten you into Bitcoin right around this level here, about 17,000 or so, and it made a pretty good run higher. Remember, we're buying on strength, not on weakness. We're not buying as it pulls back. We're buying as it rallies out of the pullback. Another entry would have been here, and then obviously an entry way up there. Now, eventually, it will not work, but that's what stops are for. And if you can catch 20 or 30 or 40 or $50,000 move in something like Bitcoin, then even if you lose on the last trade or two, that's okay. Now, this is the Landry Light pullback in a stock that we got long way back in December of 2020, and we're still long as of today. And knock on wood, I think it's just shy of multi-year highs today. And again, we're entering on strength, not weakness. So here's a simple little system or pattern, however you want to look at it, or setup, that can work quite well. It doesn't always work, but if you work hard to find the best stocks, those that tend to trend and persist in trend and accelerate in their trend, you're going to do just fine with this simple little pattern. There's our entry there. That was our stop down here. And by the way, if you want to see these without any benefit of hindsight, you can go to davelerner.com/archives and look at the trading service archives. So these were recommendations that I recommended and I actually took myself. We took partial profits here, and then we trail a stop loosely, and we kind of changed hats to go from the shorter term swing trade mode to the longer term trend following mode. And that's what you see here with that stop that we allow to loosen up over time. So again, knock on wood, we're right near multi-year closing highs on this one. So far, so good. And we just trail that stop higher. And hopefully, a word you should never use in this business, but hopefully ride the trend out for a long, long time. Now, Mr. Swag was talking about the fact that market timing doesn't work. And I got to thinking about showing my TFM 10% system. Well, since I've done that so much in these webinars, and I'm going to show you toward the end the spreadsheet from that. I know you can't wait, right? But to make my point about longer term, I thought, what would happen if I made something even simpler, created something even simpler? So we're going to buy when the S&P closes at a new 50-week high. And I use 50 weeks because 50 weeks is what I used for the TFM 10% system. And you'll see a lot of similarities to that system in just a few minutes. 52 weeks would also work, and maybe that makes a little bit more sense because that's right at 1 year's worth of trading. And then we're going to sell, and this is our performance metric, right? Or lack thereof, I should say, when the S&P closes 10% or more away from its 50-week closing high. And we are going to use weekly charts for this system. I'm actually pretty amazed at how well this worked. And I just created this morning. Today is Monday, July 25th. Now, obviously going way back to the 90s, and boy, if if I could go way back to the 90s, you wouldn't see my fat arse again, because those were really amazing markets. I had no idea that markets weren't always that amazing. But you would have gotten a buy here when the market was making new 50-week highs in 1991. And you would have ridden it for a long, long, long time. And you had a couple of sells late in the trend and a couple of rebuys. And there was one little slide in there. You could see after a sell, the market dropped about 12.25%. But that's after a 187% ride higher. And you could see we had another little sell off there. There's your buy back in. And from there to there, it's 4.6%. And then bought back in here and then ended up losing 4.58%. Now, one thing I was kind of thinking about right before I went live is that, notice we made 4.6%, then we lost it, right? So when you start making and losing, maybe you're getting toward the end of the trend. And maybe what you might want to do is be a little bit more selective in your signals. Maybe wait to see if it can stay at that closing high for a little while longer. But for purposes of this presentation, for the apologetics part, I wanted to keep it as simple as possible. So we're just buying on those 50-week closing highs, okay? And we're selling when the market drops 10% or more. And these indicators, or illustrators as I like to call them, are available in the ACP platform. They're free for now. I don't know if they'll be free forever. So if you're watching this, go ahead and download them now while they're still free. And as you know, the bear market began in the spring of 2000, late fall, early spring. Now let's take a look at that bear market, and you can see we got the sell signal here, and then we almost got a buy signal right here, but then the market sold off sharply. Now, like the TFM 10% system, the idea, as I said earlier, was less about beating the market and more about not letting the market beat you. If you lose half of your money, you have to make 100% on that money to get back to break even. And then it grows geometrically from there. If you lose 60%, then those numbers go much, much, much higher. So you don't want to lose, obviously, too much of your money, but you can see this is 10% below the 50-week closing high, and then this would actually be the 50-week closing high. And that's the entire system, just based on that. So you can see you would have avoided a 43% loss in that particular case. And then we had a bull market that followed, obviously. And it would gotten you in around April of 2003, and you would have stayed with the trend, believe it or not, with this silly little system all the way until 2008. And that was a pretty decent run. That was a 41% run higher in the overall market. And then, of course, the bear market began after that. So let's take a look at that bear market. 2007, 2008 bear market. I always say 2007, 2008 because I started seeing a lot of sell signals. Go back about, how many years is that? 12 years in some of my YouTube presentations. You'll see what I was talking about. Anyway, long story endless, you can see there's your sell signal there. And then it buys back in here. Now, it took a little while to get long again. And there were other signs of signals that might have gotten you long a little sooner. But again, I wanted to keep this system as simple as possible. Not even use a moving average, right? Just to show that something simple can work and market timing can work. And technical analysis can work. But you can see that slide after you exited was 52% from exit to the lows. And believe me, being out of the market and watching a market half is a lot better than being in a market and watching the market half. I know, Captain Obvious here, right? But I'll come back to that. That's actually a very important point. Now, in 2009, there was a buy signal, and the market had a hard time getting started. You could see you would have gotten stopped out here when you lost 10%. But you'd have made a tiny bit overall on the trade. Maybe with a little money management, you could have made a tiny bit more. But let's just look at this thing mechanical for now, on a mechanical basis for now. So a little bit over 1 3/4%. Better than poking the eye, I suppose. There was another buy here, and then the exit was here. And on this one, you lost a little bit. You were down 2% on that. Now, keep in mind, everything works better with trend. And by the way, a lot of trend following stuff will look alike after a while. I'm very proud at what I've done here and what I've done in general with a lot of my patterns and illustrators, so to speak. But a lot of trend following stuff will work just the same as my stuff. And I guess I'm not doing a good job of selling you my stuff right now, am I? But a lot of it looks alike. Once you get a decent trend, everything pretty much works better with trend, provided you're a trend follower. So you've gotten back in here. So there was a little whipsaw involved, but there was a pretty nice run coming out from the 2012 leg. And if we look at that, you would have gotten in here. You would have almost gotten stopped out a few weeks later. But if you stuck with it, because you didn't get stopped out, you would have made it all the way up until 2016. And that was a decent run, another 40% run. Now, taking a look at the 2016 buy, even though it's a bit of a whipsaw because you're getting in higher than you actually got out, or a little higher than you actually got out, 2015, 2016 was a really bad time for trading, and I would be happy to be out of the market during those wide and loose moves higher and lower like we saw back in 2015, 2016, late 2015, early 2016. So I would never fault the system for being out of the market during that type of chop back and forth. And the eventual sell was here. Remember, we lose 10% from the closing high. We exit. So that was a 24% run, better than the poke in the eye. And then you can see here, a buyback here. So you can argue that Dave once again whipsaw, but notice that you would have avoided a 10.9% diaper change moment. And I don't know if I mentioned it earlier, but I borrowed that term from Ian McActivey. And you can see here, obviously, this is the pandemic or the beginning of the pandemic bear market. And once again, it was a bit of a whipsaw signal. You might have made a tiny bit on the trade. But what's interesting is if you look at the entry right around 3,000 round numbers, and it ran almost to 3,400. So that's 400 points in the S&P 500, and that's much better than a poke in the eye. I didn't want to complicate things. I just wanted to kind of show you something simple and mechanical to make a point. But obviously, if you got 400 points in the S&Ps, you probably want to lock in some of those profits. And obviously, again, the market began to sell off hard from the pandemic back in 2020. So let's take a look at that pandemic bear market. So there was a sell signal and there was the buy signal. Now, once again, you can say, well, Dave, it looks like a whipsaw because you got back in higher than you got out. Yeah, that might be true, but notice you were out for a pretty serious slide. This is after the market exited, or after the system exited. And the TFM system, TFM 10% system, same sort of idea. It got you out. It did get you back in a little bit late, but there are other systems to look at in other market turns you might want to pay attention to, especially like on a daily basis with like Landry Light, as we just talked about. But as far as just keeping things simple, the good news is it did get you out before the market lost nearly 30% of its value. And believe me, I got a lot of phone calls over those weeks as that market was imploding from friends and relatives in a bit of a panic, and they were definitely having trouble sleeping. So by being out of the market, hard to quantify that, but as far as quality of life and knowing that your retirement is not getting obliterated can really help you to sleep at night, obviously. So that little run after the pandemic, even though the world was falling apart, right? Decent little run, about 25%. And so far, the diaper change moment has been about 13.5% since the exit. And counting, maybe, I hope not. I hope the market is done with this little bear market move, but you never know. And as Greg Morris often says, we treat all signals as if they will turn into the big one, and that's Elizabeth implied. Now, if you go back to the late 20s, obviously this is the signal you would have gotten right before the Depression, and then this was your re-entry or signal to buy back in over here. And what's interesting here is the market lost 84% of its value during that slide. So you would have avoided losing nearly all of your money just with a simple market timing system. And then I have some data going further back, and you would have actually stayed a long time coming into this big slide, kind of like we did in 91 through 2000. Now, you might be thinking, that was then, this is now. Well, if you go back to the year 2000 in the NASDAQ, you can see we had a sell signal here, and the buy signal was way back here. In the meantime, the NASDAQ lost 74% of its value. So if you had, let's say you had a bunch of growth stocks, you would have lost 3/4 of all of your money during that horrible slide. Now, I just have 10% in here shown as far as where you would sell. And something like the NASDAQ, maybe 15% might be a little bit better number. If you look off to the left here, you might have gotten a few whipsaws in this trend. So I don't have the performance metric figured out for the NASDAQ, but it might be a little bit higher than the 10% for the S&Ps. And by the way, if you did use 10%, that would probably be fine. You just would get whipsawed a little bit more. Now, getting back to the quote at the beginning, the author said, "There's little, if any, objective evidence that either tactic works in the long run." And one of those tactics was market timing. So if we look at the TFM 10% system, which has been out for several years, and you go back almost 100 years in this thing, or at least 80 years, and you could see that it's beaten buy and hope by a factor of 2.8 to 1. And that number is going to get better and better and better with every bear market because you'll be mostly out of the market. You'll avoid 20, 30, 40, 50%, and even 80% diaper changes overall. It allows you to sleep comfortably 30% of the time. So 30% of the time, you can see days out down here, it is out of the market. That equates to about 28 and a half years over the last 80 something years. And you're virtually always out of the market during bear markets. And believe me, that is hard to quantify. As I said earlier, I get a lot of calls once the market is down 20, 30, 40, 50%. And these people are usually in a bit of a panic by then. So getting back to the apologetics, I think TA does lead the way. And one thing that I often say is fundamental theories are held hostage by price, and that's probably borrowing a line from Greg Morris. He said something along the lines of all the fundamental theories in the world are held hostage by price or can go no further than price will allow. So my point is, let's just focus on price. And the reason you want to focus on price is the only way to profit from markets is to capture a price trend, period. And as I often say, why not trade with the trend all of the time? Now, just want to throw this in here. Be careful about buying value, so to speak, when the market is down. Let's say like the NASDAQ was down 50%. That might have seemed cheap in 2000, but it actually dropped another 50% from there, okay, to make it, what was that, 74% total. So one thing I often joke about is it's always darkest right before it gets more dark. Well, that's all my time. I want to thank everybody for watching. If you need follow-up information, all 3 of my books in PDF format, plus enough stuff to keep you busy for a long time. As I say, get to know me first. DaveLandry.com/StockCharts. If you need to reach me for anything else, DaveLandry.com/contact. So thanks again for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.